Welcome to this lecture on financial management, focusing on convertible securities. These hybrid financial instruments combine characteristics of both debt and equity. Convertibles are debt instruments, like bonds or preferred shares, that offer fixed income payments while providing the option to convert into a predetermined number of common shares. For issuing firms, convertibles are an attractive financing choice, enabling lower borrowing costs and deferring potential equity dilution. Investors are drawn to them for downside protection and upside potential. Key components of convertibles include the conversion ratio, which is the number of common shares received per security, and the conversion price, the implied stock price at which conversion becomes profitable. Other vital components are the coupon or dividend, representing income received, and the maturity, which often spans 15 to 20 years. Call provisions allow the issuer to force conversion under specific conditions. For example, a $1,000 par value convertible bond with a conversion ratio of 20 means an investor can convert it into 20 shares. The effective conversion price is $50 per share. If the stock trades at $70, conversion is attractive, as the investor gains $20 per share. However, if the stock trades at $30, the investor retains the bond for its fixed income. Firms issue convertibles to achieve lower interest costs compared to straight debt, often due to the embedded equity option. This can significantly reduce their financing expenses. Convertibles also provide deferred equity financing, avoiding immediate dilution of existing shares. This is particularly beneficial when stock price uncertainty is high or equity markets are unfavorable. Investors are motivated by downside protection, receiving coupon payments even if the stock declines, and upside potential, allowing participation in equity appreciation. Convertible bonds exhibit lower volatility exposure, behaving like a mix of a bond for downside protection and a call option on the stock for upside potential. Valuation of convertibles combines the value of a straight bond component with the value of an embedded call option. This dual nature is central to understanding their true worth. The straight bond value is the present value of its coupons and principal. The conversion value is calculated as the stock price multiplied by the conversion ratio. Convertible prices typically exceed both the straight bond value and the conversion value, reflecting the premium investors pay for the embedded option. The conversion premium is the difference between the convertible's price and its conversion value divided by the conversion value. For example, a $1,000 convertible with an $800 conversion value has a 25% premium. When the stock price is below the conversion price, the convertible behaves primarily like a bond, offering investors coupons and downside protection with little conversion incentive. As the stock price approaches the conversion price, the convertible acts as a mix of debt and equity with increased sensitivity to stock price movements and the conversion option becoming valuable. If the stock price is far above the conversion price, investors typically convert immediately, as the security then behaves like common stock, eliminating the need for interest payments. Many convertible bonds include call provisions, allowing issuers to force conversion once the stock rises sufficiently. This helps eliminate debt from the balance sheet and accelerate equity issuance. For instance, an issuer might call bonds at par value when the stock price hits 150% of the conversion price, prompting investors to convert to avoid redemption loss. In summary, convertible securities offer a unique blend of debt and equity features, providing fixed income with optional equity upside for investors. Issuers benefit from lower borrowing costs and deferred dilution, while investors gain downside protection and potential conversion gains. Convertibles are a valuable tool in corporate financing. Thank you for joining this lecture on convertibles. We hope this overview has provided valuable insights into these complex yet powerful financial instruments.